Yeah, we're gonna play around with a bear put spread for today's Jedi options. I'm feeling, contrary to our conversation today, which was bullish. There's some bear charts out there, and so I'm gonna give bears their due. We're gonna take a look at HOG, Harley Davidson. It's got a bear setup, which we'll get into in a second. But the strategy I'm gonna build is a bear put spread. It's a vertical debit spread, you sometimes hear it referred to as, or a long put vertical. A couple of different names, but the basic idea is you're going to buy a put option and then sell something at a lower strike. So let me tee this up by starting with the chart, and then we'll draw some pictures here. But Hog was on our report last week because of its downtrend, because it was breaking support, because it had room to drop further. And it did, but you got to bounce this week. Got a little bit of an oversold bounce, getting rejected right at the 9. So this is what we call a bear retracement pattern. And it is a continuation pattern. The assumption is that the downtrend persists. The volume certainly supports it, and that this continues lower. So you got choices on how you play it. You could short the stock, but sometimes that gets a little expensive. Plus, you got the theoretical open-ended risk. So in the options market, you could buy a put option. It is a $33 stock. It's cheap enough for buying a put. But oftentimes we do the spread variation of buying a put because we want a higher probability, because we want a cheaper cost, and maybe just an easier overall trade to manage. And so that's why I think HOG is a good example for the bear put. So as far as the chart goes, with building the trade, what we're going to do is we're going to buy like a 32 put. Okay. And then I'm going to reduce the cost by selling a put below that, maybe down around like 29. And by doing that, I'm going to get paid some money with that short 29 put. And that's going to reduce the cost of what I'm paying for the 32 strike. Now, notice I'm buying a slightly out of the money put. You can really structure this however you want. I'm structuring it a little bit more aggressive, which is going to make it cheaper, and I'm going to have a higher payout. This $3 spread is trading for about $1. It's trading for about $1. So conceptually, let me build this out. I'm going to draw something here real quick. You with a bear put, you decide the time frame. The thing that you'll learn with buying options is just a scale. If you go super short term, you're on the really aggressive end. If you're right, you'll make money much quicker. But if you're wrong, you'll lose money much quicker. And if you go on the longer end, buying further out in time, you're on the more conservative end, which is if you're right, you make money a little slower. But if you're wrong, you lose money slower. So you kind of have to decide how impactful, how potent you want the trade to be. I'm actually going to go a little bit more aggressive, and I'm going to go June, which is 28 days. Correction, I'm actually going July. July's the one that had the strikes I needed here. So this is going to be a little bit more conservative, but it gives it more time to be right, if that makes sense. So I'm going to buy the 32 strike. Okay, and that cost me $1.65, which, it's not all that expensive. It's a $32 stock. If you're going to buy a put or buy a call, $30 stock's not a terrible one to do it on. But what I looked at is I'm like, I don't know that it's going to get all that much lower than 29, 28 anyways. So I'm willing to cap my gain down there in exchange for reducing the trade cost. So I was first looking at the 29 strike. And if you just control click on the bid price, you'll sell it and it'll link it to the long put and create a vertical spread here. But it's 88 cents for a $3 spread, which means I can make a little over $2. Okay. I like that potential payout. If I look at the risk graph here, you can see not a lot of risk, a lot of potential payout. I like that asymmetry when I'm going to go directional. Okay. And if I am bearish and I really think that HOG is going to get its clock cleaned, then I think that this is a good fit, risking a little to make a lot. So if you look at the chart, and you back this out, essentially 29 is the ultimate target. The other thing that I like, just extend that to the left, there is some support down around 30. That's probably your first target. It doesn't have to get to 29. I mean, even if it drops to 30, you're up 66 bucks on an $88 investment. At expiration, you're up $111 on an $88 investment. That's a pretty good return, right? Over 100% return, which is appropriate, and I think a good fit for being short-term bearish. I didn't have to do a $3 spread. I could have said, well, let's go for a little more profit and widen the spread a little, sell a 28 strike against it. There's different theories or logic you can use for which put to sell against the one that you purchased. For me, I kind of like just selling what is my target. Where do I think the stock could go? If you sell a put much further below that, it may not reduce the cost as much, and it may be unnecessary because it's not going to get down there anyways, right? So $3 wide spread for a $32 stock, I think is a good fit as well. Kind of like a $5 spread for a $50 stock or a $10 spread for a $100 stock. I think it matches the price pretty well. From a risk perspective, it's also cheap enough. It's also cheap enough to where if you didn't want a stop loss, you could just risk the 88 bucks, give it plenty of room, and you're fine. But you could manage this like a normal directional bear trade, and you could use a stop loss, right? I mean, if you want a tight stop, you could go over the pivot high here, yesterday's high, right? You could use a 20-day moving average if you want a little bit more room. I think you got your choice there. And then again, from a target perspective, I like 30 bucks as kind of the first level, as you got a lot of prior history there. I would be surprised if it sliced right through that and hit 29 on the first attempt. Okay, so just to sum up, I've got let me phrase that differently. Let's look at the Greeks real quick, just so you know what the Greek characteristics are. Negative 20 deltas. It's like I'm short 20 shares of stock, but I'm doing that with $88. It's dirt cheap. Okay. I'm long gamma, which means I'm going to pick up some exposure. As the stock drops, that delta is going to get bigger. Okay. So the amount of exposure is going to increase, which means my gain is going to accelerate if it works. The time decay is negative. So it is a negative theta trade the way I structured it. So it's a race. I am losing money as time passes. Although I would say I'm not losing as much money on time as if I just bought a put. Okay, I'm hedging my time decay or theta exposure by doing a spread instead. So it's going to be a little bit easier to hang on to it and give it time to work. And it is a long volatility trade. You bought almost an at-the-money put. And so if options are cheaper, that's going to work to your advantage. It is a debit spread. They work better when vol is low, which I would say in general in the market right now is true. Volatility is lower right now. So those are your Greek characteristics. But it's just a very good, I think, alternative to shorting stock when you want a cheap downside play. HOG's a good example. Probably will be on our scouting report unless it does something crazy. Nice little downtrend here. So I filibustered my way through drawing a picture. No pictures today, but you got the risk graph, you got the order entry there. You got a nice little structured bear put. That's your Jedi options for today.